So I hope you guys are doing good today. Today's going to be a pretty theoretical one. I'll show you one test, and it is really meant to, it's not a trade idea. So I don't want to give you a bunch of different trades. I want to kind of talk through some theoretical stuff today. So before we begin, and please talk/type, or else it's just going to be me rambling about. So have any of you ever read and or done tail hedging? Could someone put in the description what a tail hedge is? Why do they call it a tail? We got some typers. I like it. That's exactly right, Amy. The left side of the tail, they can go both sides. If you've ever GameStopped, as I know, my partner in crime, Mr. Matt Simon, has definitely GameStopped in his life and has the T-shirt to prove it. It can go both ways. But normally, when we're talking about tail hedging, most people are talking about the left side tail. And when we're thinking about hedging, I always like this. We've done this for a couple months now. We've had this back tester, and a lot of people have asked because they know kind of how we got started, or how I got started trading options. Have I found a good hedge? And that is a tricky question to ask over time, right? Because a hedge largely is a partner with whatever position you have, right? So if you are long, I always say Oxycontin. If you're long Occidental Petroleum, or you're long PBR, or you're long some Petrobras or some oil company, normally, unless you've done some crazy AI stuff, and if you have, hit me up. Would love to hear about it. But unless you've done some crazy AI research that shows a hedge tied between oil and Bed Bath and Beyond, you're normally not going to just pick puts on something that's not correlated to what you're doing, right? I don't think you guys are smart people, you know that. But you also are probably smart enough and seasoned enough to know that we all do that at some point in our life, in our trading career. We kind of under hedge a little bit. And so the first thing you have to know about hedging is it's normally correlated. Tail hedging is something a little bit different, though. Tail hedging is not for you have a long portfolio, and you're trying to mitigate risk down to 20%. That's not what tail hedging is for. It can be used for that, but it's not the main thing for it. Tail hedging is for when what Nassim Taleb famously calls a black swan event occurs. And we have had black swan events in the last couple of years. Can you guys name some black swan events in the last couple of years? There's actually been a couple in the last, let's say, 5 years. Can you name some? That's right, Joseph. Yeah. So the big one is COVID, right? COVID was the biggie, like a classic crash, a very accelerated crash, a high VIX crash. I'm glad Short Vol said it. Volmageddon. Was anyone trading during Volmageddon? So it was a glorious 2 days. Tom Brady had just lost the Super Bowl to the Eagles, I believe, to the true goat, Nick Foles, and whoever Tom Brady's playing, I usually say, is the goat. So for those of you who weren't trading Volmageddon, basically what happened, and this is kind of the hindsight thing. If you were watching it that day, you had no idea what was happening. I believe it was a Monday. But if you remember, and I'm sure you've backtested, if you've backtested 2017, that was a crappy year for options. No doubt people did well in it. There's always caveats. But in general, vol just absolutely got smacked to death in 2017. I believe, I could be wrong, that VIX recorded a historic low that year. I think VIX got down to like 980 or something like that. And so it's always funny to me when people are like, VIX is too low right here. I'm always like, guys, it's like a 25 VIX. It's pretty damn high for where I've been. But yeah, exactly. I mean, VIX was pretty low. And that actually, when VIX gets that low, it actually makes much of anything. It's the ultimate stuck in the mud thing, right? So VIX just got annihilated. Just VIX was homeschool Troy, at the prom. Just nothing's happening. Nothing's going on. We're dancing alone to Newsboys. That's a different story. So 2017 happens. Thank you. Just throw that out there. 2018 pops up, and suddenly on a Monday, vol. Correct me if I'm wrong. Someone can speak to it. I think the VIX went up 80%, 90%. It might have topped out over 100% in a matter of hours, right? And it wasn't like a flash crash. It wasn't like it came back down that day. It actually ended, I think, at the peak. And maybe the last 30 minutes there's a little bit of reprieve. That's right. So you had these ETFs that were selling premium and just absolutely crushing it. 2017, people are selling vol, and you have ETFs. Was that an ETN or ETF? I can't remember, Ro. But you had these ones called, ENT. So you had XIV, which was, I believe, triple levered or double levered, but it was selling vol and had done a wonderful job. People figured this was a great piece to add to their portfolio. And then on that Monday, what happens when a 2x levered, 3x levered ETN that's selling vol, what happens to that ETN when vol goes up 100% in a day? Wow, 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 wow. That's right. Yeah. Thank you. I knew you were going to do it. I knew the wizard. I knew he was going to find the correlation. That was an Easter egg I threw out there, and he did it gloriously. So there is a correlation to it. That cracks me up. But anyway, so saying all that to say, suddenly vol had coiled up like a snake, and it was unleashed, right? And then because people are insane, they continued to sell vol, elevated vol. I'm going somewhere with this, so I hope you guys don't mind me just rambling for a second. This is Troy's macro view of things. 2018, vol was elevated, but it got pushed down again because people were just relentless in vol selling. If you remember 2018, Powell, towards the end in the fall, said he was going to raise rates. I personally think they should have, but who cares what I think? It has nothing to do with what I think. But the market freaked out, and the market started dropping. And I can't remember, I think it was 20 or 30% decline. But compared to VIX, the Volmageddon, VIX never woke up in that environment. It went up, but it didn't touch really with the perhaps the highs of the year, I think. I'm speaking from memory here. But it was a similar environment to now, where VIX was elevated, but it didn't get necessarily into a crazy backwardation state, like a crash state, right? And for those, just review, contango means the VIX futures normally in a curve, because the future isn't as known as the present. The future is priced higher, right? VIX futures are higher in contango in the future than they are now, right? Because we know what's going on now, day-to-day basis. We know volatility. In backwardation, that flips, because when you have an event that's upon us on the, no longer on the horizon, but we're here, vol can get super elevated, and the front month VIX futures can actually get higher than the back month futures, and that's called backwardation. So what does all this have to do with hedging? Prior to Volmageddon, I don't think people would have said that VIX is going to go up 100% in 4 hours, right? No one would have thought that, right? Everyone secretly thinks, like with vol selling and premium selling in general, this idea of picking up pennies in front of a steamroller, everybody knows that's bad, right? Everybody knows not to do that. But here's the secret human part to all of us, is that we all kind of think that it's a steamroller, so it's slow. So I'm just going to get a couple pennies, and then I'm going to get out of Dodge. No one understands that that's not the analogy with hedging. That might be a normal hedge. Picking up steam, getting out before the steamroller hits, that's what you do with normal hedging, right? You sell a put spread and you see it going down and you convert it to a long butterfly. That's like day trading hedging, right? We're not talking about that. We're talking about picking up pennies in front of a jet, in front of a F-18. Because when vol hits, it's very, very difficult in that moment to hedge properly, right? It's very, very difficult, because what's happening is you're having standard deviation moves that are completely not priced in yet. So what happens when they are priced in? When they're priced in, you're going to pay a freaking premium for them, right? That's the Nassim Taleb uses this example, I think in Black Swan, could be somewhere else, that someone pays insurance on against flight insurance. They pay for their flight. We're going to have a safe flight from Knoxville to Destin for the weekend, or Knoxville to DC, or Knoxville to Manhattan, or whatever. And the flight insurance covers terrorist attacks. Well, which one's going to be more expensive? That coverage pre 9/11, or terrorist insurance post 9/11, where you don't get any other insurance benefits except for just terrorist insurance. Well, because 9/11, the premium obviously would be jumped up quite high on terrorist attacks. Someone creating a terrorist insurance did really well for 4 weeks after 9/11, right? That's the premise of it, because everything's being repriced. Everything is having to settle in at that moment. So that is where we come in with tail hedging. So real quick, in the chat or talk or whatever you guys want to do, have any of you hedged far out of the money tail events, like 6 to 20 standard deviation events? Have you ever hedged towards that before? Cool. Yeses and nos. That's great. Yeah, basically far out of the money puts or calls, with the idea of saying, like, this is not an investment strategy. This is something different. This is for an emergency, right? So if you said no, understand that that's completely fine. I'm not sitting here advocating for people who don't have the majority of their money in a 401k, or they have the majority of their wealth in an account, that it's necessary, right? Because again, the point of hedging is you're correlated to what you have risk, what your risk is, right? In general, you don't necessarily need to do that. Like you don't have insurance for everything in your life. If you do, God bless you. You're paying a lot of money. I didn't buy motorcycle insurance until I had a motorcycle, right? I always thought motorcycle insurance was probably pretty smart Could have, but I wouldn't have had any benefit from it. Now, this is a little bit different. I say all that to say, though, this is a little bit different in that if you have some sort of macro view of the market that you want to take, tail hedging can be an interesting way to do that. And I'm going to show you here in a second. I'm going to talk my book a little bit today with the understanding that options involve risk, are not suitable for all investors. This is not investment advice. Backward looking, not forward looking. This is for entertainment purposes only. So I hope you're entertained. But we all kind of have this notion that when you're buying something that has like a 0.00002% chance of happening, most people say you're wasting your money. When I told people about buying a bunch of puts a couple weeks before Volmageddon, they largely said, "That's a really cool idea. Let me know how it goes." Side note: you're just gonna waste your money. And then when COVID hit, people got super interested, and it was interesting to watch the psychology of it because people who weren't interested in the stock market saw the stock market, knew I was doing that, and suddenly they're like, "Can I do that too?" I would have people say like, "Hey, can I buy that?" And the reality is you couldn't at that point. I mean, you obviously could at different points, but I'm saying like as far as like what you're doing it for, it would be very difficult to do it. All right, I've talked a lot. So if you look at the very top of where we started today, around 203, I posted a screenshot, and I have not logged into Robinhood in a long time, but I logged into Robinhood because I used Robinhood a couple years ago for this purpose. I didn't want to put this in my main trading account. I wanted it to be something separate that was an automated process for me. Automated in the sense of like I just did it manually every 60 days. But I did this in Tail Hedging. And what this is this is VXX calls. I bought February 27th. Now, I had been doing these in smaller size before. But when Rusty and I and a couple of people at work started to realize what was happening in China with COVID, I upped the ante a little bit, and I bought $350 worth of calls. So VXX is a long vol fund, so calls are it's inversely correlated to the S&P, so it's going to go up if the S&P goes down largely. This year, there's some caveats to it, but anyway. So I bought these 70, I believe, 70 contracts, and I bought the 60 call when it was at 15 or 16 bucks, I think, VXX. And you can see, and there's plenty of fun things to make fun of me about, but this is kind of just showing tail hedging. I bought 70 contracts on on February 27th. And then if you look at the top, I sold 35 of those contracts, half of them, for $38.85. And then the next day, I sold the rest of them for $10,185. I'll give you the TLDR. If I would have sold the top, which is the exact opposite of what you're trying to do with tail hedging, I think they were like 100. What's the point of that? Is to show off? Certainly not. Who cares? Who cares? My point though is to show it's the clearest example, and I screenshotted it forever and like saved all the vol, where vol was at and IVs were at with SPX, and I have a little folder to remind myself of what happens when the impossible happens, because you can so easily forget that these things are possible, right? Like even in the midst of this downturn in market, if anybody has their brokerage open, I don't have it. What's the today's IV? If you can see on SPX, does anyone have that open? Okay, thank you, Shortwell. So 38.6%. During the height of the COVID crash, IV for front month was 250% for SPX. No one believes you when you're trading these until it's happening, right? Until it's who would believe that you could spend $300 on something, $350, and sell it a month later for $10,000? Well, GameStop taught you that you could in different ways, but in an index, that's the kicker of it. Like making a bet on an index and what an index is going to do. That's something different, right? So I say all that to say, tail hedging, what you're doing is you're not trying to account for when the SPX is going to drop 30% in a year. What you're accounting for is when 9/11 happens, when there's a virus that no one knows if it's going to kill everybody or not, when vol goes up 100% in a day. The flash crash, we don't have data on that, but it probably would have been the same thing around 2010 when the vol. Does anybody remember what the flash crash, what the numbers were on that, like how far it dropped in 20 minutes or whatever? Okay, thanks. So 23% today, 34% tomorrow. Yeah, when the flash crash dropped, I think it was like 10% in 20 minutes or something crazy, and then recovered. It's for things like that where there's unknown things that are happening in the market. When the unknown things have become known, the black swan events happen that no one saw coming. So how do you hedge that? How do you do this to where it's not a drag on your portfolio over time? That's the key, right? That's the thing we're talking about, because who cares? Like I turned $350 into $10,000, right, in a month, right? That's not what we're talking about. If I spent $350 a week on that, or $500 a week, or $1,000 a month, or whatever my portfolio size was, if I'm spending 20% of my portfolio on hedging, it can't do that. Tail hedging, the only way it can work is if your payoff is so asymmetrically great that it can carry for years versus your long portfolio without being a drag. Does that make sense at all? That's right, bro. So someone who says, I'm going to tail hedge and I'm going to put 80% long and 20% short, and let's say for the last 10 years, like we've had a bull market, well, you have massively underperformed people who are just 100% long. That's just, I don't have to show you a graph for you to understand that. If you put 20% of your portfolio in things that are expiring, we're talking about options here, you have a huge carry, a negative carry over time. And so you have to be really, really selective. It's an art, as you guys all know as option traders. It's not something that you can just say, this should work, 20% should work, blah, 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 blah. It has to be so cheap compared to what the payoff is that your payoff has to cover those negative years of carry. And so Nassim's famous thing about this is, like, during the crash of 87, he had, I don't know if it's puts or calls, probably calls, I can't remember. He had just an inordinate amount of puts and calls at like a 20 standard deviation payoff, because he was paying OTC prices. So they were just giving them to him basically. And he just carried these, right? But they were so cheap. He just had a crap ton of them. And then the crash of 87 hit, and, his trajectory of his career changed through that day. And someone asked him, said, yeah, but how long could you have carried that negative carry looking back now on the crash? Like, how long could you have carried those assuming we didn't crash? Well, after the crash, what he determined is that he could have carried those for 67,000 months, right? That the payoff of his hedge tells were so great that he could have afforded to carry them negatively for 67,000 months. That's the type of asymmetric payoff you want when you're looking at a hedge. Does that make sense? That's also why, if after 2008, a bunch of black swan funds opened up with like ETFs and things like that, and the vast majority, like 99% of them, have all gone bust because they just have negative carry month after month. And usually, how they're doing it is they're rolling futures, which when you're in Contago for the majority of the time, you're losing money every month, right? So those things are very, very difficult to do through time. And the payoff has to be, again, so great that it can afford to. And most of the time, the way they've structured these hedges, they can't. It's not worth it. So the big macro point of this is to say, when you're looking at your portfolio, when you're looking at your stuff, you have to think of tail hedging differently, because most of us, I think, are shorter term traders. Day time frame to let's say 60 to 90 days out. So a 90-day out would be a longer time frame. That's right. That's exactly right. Yeah, at least they were cheap. I still have faith. If you listen to CNBC, I heard someone like two or 3 days ago that said 4,800 is still the target for the end of the year. So you might be on your way. These things you have to correlate, right? Like if you're selling 0 day, if you're selling 0 day puts, a 60-day SPX put is not going to do you much good, right? You can't even think about it in those terms, right? But if you have anything, most people have 401ks and stuff like that, it starts to make sense in some ways to think through some of this stuff. So with that being said, I'm not going to give you the joy of hedging. The large part of why we did this backtester was to try to think through this stuff. And so I'm not going to give you any of the cookies, but I will say there's cookies in there. The jar for all subscribers is open, and you just have to look in there and find that gold and them hills. But I will show you one test that is interesting. I'm going to let some typers type, though, because I need to take a drink and be like this. Oh, bad news. My lighter's out. Son of a gun. Party's over. Well, let's look at a test together. So give me 1 second here. Okay, I'm going to share this in the chat. Can you guys see my screen? Cool. So what this is about as simple as you can get. And it's, I'm cherry picking. So this is the COVID months. Okay. So I'll give you the test and then show you the caveats and like the homework if you want to do it, because this is super fun. What we're doing is every 60 days on a Monday, every Monday, we're buying a 60 DTE put, and we're buying a 1 delta put. A 1 delta put, 60 days away, and it doesn't matter what time of day. If you find a secret to that, I'm going to go ahead and say just ignore any time of day with this stuff. That's not what this is about. We're not looking into that stuff. And what you're going to do is you're going to allocate 1% of your portfolio, just 1%, just a little bit of sugar, just a little leaven, and up to 100 contracts per trade probably is only going to be applicable here if you have $1 zillion in your account. And the only exit condition we have for this simple test is we're going to exit at 1,000% profit. Okay. Now, again, this is so skewed, and I'm not selling you anything. I'm just trying to get you to look at what happens during a crash. You have, again, I'll save it for the caveats. But we have all our stuff. We require 2 profit targets, have slippage put in, having opening fees and closing fees. Well, during the COVID crash, obviously you did really, really well, right? You did really, really good. Lots of 1,000% winners on a 1 delta put. What's interesting about this is I started with $1 million. Let's go down now and say 5,000. You're not going to have enough money. So let's say we're going to allocate, I want to try to keep it as small as possible. Yeah, we'll keep it going real quick. I'll go to 5. Okay. So a small account requires more capital. You're going to allocate 5% of your account. So during COVID crash, carrying a 5% allocation of far out of the money puts returned you a CAGR of 13,932%. That in of itself should, I hope, like spark a fire, right? Of just like interesting, crazy 1 delta puts on SPX did really well during COVID crash. And some of the things to take away from this, in my mind, are you don't have to buy 50 delta puts during a crash. It's not about the movement. It is obviously about the movement, but a tail hedge, an event like this, it's equal parts vol expansion as well as movement. Volmageddon's the perfect example of it. Like the movement had nothing to do with the movement for the day. I think we were down 3% that day, maybe 5%, but it wasn't like a string of 5% days. It just had this weird one-off day. I think Friday was a little bad, maybe down 2%. But we just exploded. It's not about the necessarily movement. That's the thing when people say a 1 delta, like it's never going to get there. It's never going to. It's not about getting there. It's not about your view of where you think the market could go. And that's the one thing I think I would just encourage you guys in as you look about tail hedging. It's not about where it can go. It's about what's going to happen on the way of getting even close to there. It's not about getting there. It's about the possibility that it could get there. That's what tail hedging is about, right? And that's what these events are about. It's not about whether it gets there. It's about the fact that it could get there. That's what scares people. That's what reprices. That's what causes IV to be over 200% in front month SPX options during COVID. So here are the caveats to it. And here are the things that I'll encourage you guys in. And we'll look at some more tomorrow. And then we'll probably take a break from it just because, unless you guys want to keep talking about it. It's awesome, but it requires it requires a lot of testing on your part. And more importantly, it requires you to think about your account and your portfolio and what you're trying to hedge against or profit from some uncertainty. It might not be SPX. I chose VXX calls at that point. It could be different things, but it's interesting to think through with the backtester. That's exactly right. No 2 crashes look the same. You can also test 2018, and it tests a lot differently. So you have to put some thought into it. So here's the caveats. This is COVID, right? Let's run this again, COVID to year to date. This time, actually, let's go back to $1 million. Go back to 1. So like that. There are not that many, Matt, and that's right. And that's why COVID was such a gift to backtesters everywhere. What happens if VIX goes from 20 to 80 in a month? We now have that data, right? It's one data set that we have. Okay, so this is the beauty of it. If you did this for starting in COVID days going to now, you'll notice that it has not worked too well, right? You would have, if this is your only strategy, it is a crappy strategy. It's been terrible. And so people say, well, yeah, you were just cherry picking COVID. Of course it did well during the COVID crash. Exactly. That's why these things all have to be in parallel to the number one bullseye of investing, which is we are trying to make money. So a hedge cannot be so heavy a negative carry that it keeps you from profiting, right? Who cares if it helps you during a COVID crash if it just is a giant weight around your neck when it's not? So here's my TLDR. There are ways to do that. There are ways for there to be asymmetric payoffs and asymmetric risks, or asymmetric payoffs while hedging your risk and have a positive carry. That by the time it's done, if you look at a strategy, a long strategy with a hedge, that it outperforms the S&P over time, right? That's the end goal, right? If we're largely basing our investing on the S&P. It should outperform the S&P over time. So your hedge should not hinder you in that journey. It should help you in that journey. It should not just be for, well, worst case, it'll mitigate. It should be such an asymmetric payoff that it actually helps over time because you're losing so little and then you're gaining so much during these moments. Any thoughts or questions or anything like that? So I desperately look for a lighter. Good. Thanks, Amy. Now, what's also fun, this is where we could do this forever. This is classical tail hedging, right? One delta puts far out, then implement your specific kind of sugar sweeteners to them to make them actually really good hedges. That's classical tail hedging. But to my point about if all of you guys are trading 0-day, is there such thing as a 0-day asymmetric hedge that you could backtest? I think there are, right? Let's say you're doing double calendars, 1 day out, 2 day out, whatever. Is there a way to trade asymmetric payoffs for those? I think there are. So that's the fun of it, is correlating to what you're doing on a day-to-day basis, right? And so the journey continues. I'm excited about it. But like I said, you don't have to do it, right? You should think through it. It's a good exercise to do as a trader. You'll wish you absolutely would have done it during a COVID crash. I can say that. But you don't have to do it. So yeah, that's a short while. That's the exact type of situation where you should look at. I mean, we in our tester have the ability to look at different VIX levels. I'm not going to give any hints, but might be interesting to look at allocations based on VIX levels, things like that. So with that being said, maybe what we'll do tomorrow is I'll show you some more of these classical tail hedges and maybe look at some Qs because Qs were fun during COVID crash. We can look at those. We can also look at IWM. IWM just got trying to think of a wrestling put in a figure 4 during COVID. It had the elbow drop applied to it, the atomic leg drop. The Stone Cold Stunner. Thank you. Friday we'll just talk about wrestling moves. So tomorrow we'll look at some classical tail hedges, and then maybe Thursday what we'll do, just for the fun of it, is we will send me. This is what we should do. DM me like what you trade, the type of trades that you do, and then let's maybe build out some hedges based on that type of trading that you do. So if you trade 0-day tranche trades, let's look at what an asymmetric trade might be for that. If you trade 1-2s, let's think about what an asymmetric. So send me what you want to look at, and we'll maybe build some out together and go from there. So with that being said, I appreciate y'all. It's a beautiful Monday in Knoxville, Tennessee. Hope you guys have a great rest of your day, and we'll meet again tomorrow. So happy trading to you. We'll see you soon.